सो हेलो गाइस, वेलकम टू माय यूट्यूब चैनल। आज हम पढ़ेंगे क्लास 11th कॉमर्स चैप्टर 8 सोर्सेज ऑफ बिजनेस फाइनेंस अ डिटेल्ड सॉल्यूशन। So choose the correct answer. First, out of the following, which is not a source of ownership capital? Debenture. Who are called the true owners of company? Equity shareholder. Which shares are offered to the manager are discontinued controlled price or instead of cash sweet equity share. Who has the first right to receive dividend from profit of economy? Preference shareholder. At the time of liquidation, who gets capital first? Debentures holder. The capital invested in the assets of capital is known as which capital? Fixed capital. What are the debenture holders of the company called? Creditors. This is the internal source to satisfy the long-term finance requirements for business unit. Plogging bag of profits. Which companies can plug back the profits? Financially sound company. How does the government get finance to implement long-term project by board? The proper source of getting short-term working capital is trade credit. Answer the following questions in one sentence each. Which shareholder are the true owner of business? Equity shareholder. Who has the first right to receive dividend from company's profit? Preference shareholders. State the sources of borrowed capital. Borrowed capital can be raised majorly through debentures, bonds, public deposits, loans from financial institutions, commercial banks, trade credit, and internal deposits. What is a convertible debenture? If a company has announced that after a specific time debentures will be converted fully or partly into equity shares, then such debentures are known as convertible debentures. Explain the following terms: IFCI, IDBI, ICICI, GSFC, GIIC. So we have to give the full form. So the full form of the abbreviations are as follows: IFCI, Industrial Finance Corporation of India; IDBI, Industrial Development Bank of India; ICICI, Industrial Credit and Investment Corporation of India; GSFC, Gujarat State Finance Corporation; GIIC, Gujarat Industrial Investment Corporation. State the main lending policies of commercial banks. Banks truly analyze the financial requirements of a business, its ability to repay income tax returns, old and current accounts, profits, etc. If the bank gets satisfied, it can lend money in the form of loans, cash, credit, and overdraft. Answer the following questions in short. Give the meaning of capital from the view of commerce. Business finance. The word capital has a limited scope when one talks in terms of accountancy. As per principle of accountancy, money is invested, goods and assets when clubbed together is called capital. Commerce has a broader meaning for capital. As per commerce, capital includes owners' invested money and money borrowed from different financial sources. Thus, capital means funds raised to satisfy the various financial requirements of the business. What is called sweat equity share? Equity shares issued by the company to the directors or employees at a discounted price for a consideration other than cash for the specialized knowledge and skills that they provide to the company are known as sweat equity share. Why preferences shares are called the shares of preferences? The shares that get the first preference to obtain dividend by during liquidation, the first right to get the capital back, are called preferences shares. Since these shares get the first preference to obtain dividend and claim the capital, they are called preference shares. State types of preference shares. First, preference shares redeemable before 20 years. Second, preference shares redeemable after 20 years. Why ordinary equity share is called risky share? The buyers of equity share take a lot of risk on their heads by buying the shares. They know that the price of shares may go down in the market. They also know how that they may or may not get dividends, and also that the amount of dividends will never be fixed. In case of liquidation, when company pays off all debts and if it has some money left, only then it will given the capital back to equity shares. Owing to several risks that equity shareholders take and still remain stuck to companies and investors, they are known as true owners of the company. What is the main difference between bond and public deposit? Bond are bond issued by government or corporation and tradable debts security with fixed interest and maturity dates. On the other hand, public deposits involve companies directly collecting fixed term funds from the public offering a fixed interest rate. Bonds are subjected to market regulations and can be traded, while public deposit regulated for depositor protection and non-tradable communities. What is a floating charge? Floating charge. Floating charge is used by a company to borrow capital against debentures. It is a charge on assets of the company. The charge keeps on floating as per the property which is covered. A specific characteristics of a floating charge is that the company can continue to use the assets even when the assets are mortgaged for debentures. Answer the following questions in brief. Explain advantages and limitations of ordinary equity share. Advantages of ordinary share. Shareholders or investors buying these shares and considered the true owners of the company. Shareholders can earn good dividends. Shareholders have right to attend general meeting and right to vote and elect directors. Prices of these shares fluctuate frequently, and so one can make good money by trading them in the share market. Shareholders may also get bonus shares for the company. Disadvantages of ordinary shares. Owners of ordinary shares are under high risk of price fluctuations of share in the market. In case of liquidation of the company, they are the last to receive capital invested in their share. They may not get or may get very less dividend through they have voting rights, but small investors may not be able to put their words in companies management due to domination of directors and big investors. Shareholders may victims of speculation. Distinguish between equity share capital or preference share capital. Points of differences: equity share and preference share. Compulsory. It is compulsory to issue each company. It is not compulsory to issue such share by each company. Rate of dividend. Rate of dividend is not fixed. Rate of dividend is fixed. Rights. There is a right to attend company's meeting, to vote and elect managers. There is right to vote only in matters related to their interest. Risk. Proportion of risk is more. Proportion of risk is less. Investors. The shares are preferred more by investors who wish to take risk and speculate, gamble in shares. These shares are preferred more by such investors who wish to get fixed income and security of capitals. Market price. There is increase decrease in market price of shares. Proportionately, the price of shares remain fixed. No increase decrease in market price. Addition in capital. In this type of shares, capital can be raised by right share and bonus shares. Capital is not be raised. And third question. Explain the leading policy of commercial bank. Bank truly analyzes the financial requirements of a business. Its ability to repay income tax returns, old and current account, profit, etc. If the bank gets satisfied, it can lend money in the form of loans, cash credit, and overdraft. Distinguish between ownership capital and borrowed capital. Basics of difference: owner's fund and borrowed fund, meaning funds invested by shareholders is called owner's fund. Funds borrowed from other sources and invested in business is called borrowed fund. Source can be received from equity share, floating back of profit, depreciation fund and reserves can be received from debentures, commercial bank and financial institutions. Return. Return is in the form of dividend of owners fund. Return is in the form of interest at fixed rate. Rate of return. Rate of return is uncertain or not fixed. Rate of return is fixed. Repayment of capital. Owner's fund is repaid at last. Repayment of borrowed fund is made easier than owner's fund. Write short note on bond. Bond. Bond is a source for long-term financial requirements of the company. Bond is borrowed capital is usually more than debentures. Mostly these are issued by government, municipal corporation and companies. Bonds are also known by the name given in the issue. Example: Sardar Sarovar Bond. Bonds are issued for a fixed time limit. Government and companies when want to implement large size projects and to satisfy long term requirements, bonds are more suitable. Trade credit. Trade credit. Business units have needs of raw material, finished goods or other tools and things. In this situation, a business unit purchases from other producers or traders on credit from some time period and credit working capital. Thus, the creditors do not provide capital directly, but by giving goods or services on the credit, they satisfy the capital requirements. Intercorporate deposits. Usually, when a company gives deposit to their company which is in need to fund, then such deposits is called intercorporate deposits. Usually this type of transaction occur between a major company and a minor company. Also happens between various companies managed by one group. Rate of interest and time limit is decided by an agreement. As compared with other sources, this borrowing is easy. Public deposit is known as fair weather friend. Explain statement. Fair weather friend is a friend who is friendly or available only when it is advantageous to him. People invest money as public deposit in companies when they get acquired returns. Interest of these depositors is purely to earn by lending money to the company when the company is under the financial crisis, and if such news or rumors get spread in the market and depositors rush to company to withdraw their money even before the maturity date. This creates financial problems for the company, and so the public deposit are considered fair weather friend. Blocking back of profit is not possible for every company. Explain statement. A company retains profit in the good time of business. A company can only retain profit if it does not have liability more than its assets. For a new company, a small company or financial weak company, making profits and maintaining its position against strong and established companies itself, is a challenge. Moreover, such companies also need to invest more in modernization, expansion and innovation of their business so that they can have a strong foot in market. They also need to provide dividends to maintain the faith of investors and encourage them in investing in their company. Hence, retaining profits is not possible for every company. Answer the following questions in detail. Explain the factors deciding the need of capital. Need of finance capital. A businessman needs capital to conduct all the business activities effectively and on time. Following points clarify the need of business finance. For establishing business, various expenses are to be incurred to establish the business unit. Capital is required to meet expenditure like conducting primary and extensive research to be prepared documents like certificate of registration, fees, experts in the field of law, registration fees, etc. For purchasing fixed assets, the long-term investments made for the assets of business unit is called fixed assets. In this type of assets, frequent change is not possible. Long-term finance in large proportions is needed for acquiring fixed assets like land, building, machinery, vehicles, etc. There is a mistake, it's capital. Okay. Then third, for current assets, working capital is required to carry out daily activities smoothly in the business. Working capital is needed for the purchase of raw material to pay salary and wages, to make payment for services assisting trade, and to invest in the stock of finishing goods. For modernization and expansion of business, capital is required in the large proportions due to new invention. For modernization, expansion, and to adopt new production technology in the business. For accidental requirements, there are many internal and external factors which affect the business unit, due to which requirements of capital arise to meet the factors like employee strike, change in government policy, trade cycle, natural disaster, etc. Define share and explain characteristics of equity share. Equity share. The share having last right to receive dividend as well as capital compared to preference shares are known as equity share. Characteristics of equity share. True owners. These type of shareholders are called true owners of company or faithful companies companions, because these take more risk and preference shareholders. Right to vote. Equity holders have to cast votes towards as per shares held by them. Rate to dividend. For such shareholders, the dividend and rate of in dividend is not fixed. For profit related, dividend receivables to such shareholders is related with profit, hence dividend with increase decrease with profit. General meeting. These shareholders have right to attend the general meeting, vote and elect the directors. Repayment of capital. Generally the share capital is not repaid during the existence of company. Dissolution. Liquidation. At the time of liquidation, after the repayment of capital to preference shareholders, capital is repaid to equity shareholders if surplus funds are available. Share of qualification. If there is a provision in the memorandum and directors have given consent to become the elected directors of company, then this share is consent as share of qualification. Capital benefits. These shareholders receive various benefits, right share, bonus share, benefit arising due to increase in share price in market, etc., called capital benefit. Registration of shares. This type of shares are registered in recognized share market. So purchase and sale of share at market price can be done freely. Give the meaning of preference share and explain its characteristics. Preference share. This the share having first right to receive dividend from economy's profit, and at the time of liquidation of company have first right for getting repayment of capital. Such shares are called preference shares. Characteristics. Dividend. Preference shareholders have first right to get dividend at fixed rate. Right to vote. Preference shareholders have right to vote for matters relating to their interest only. Preference. The investors preferring to buy this type of shares as they like to have a steady fixed income and security for their capital. Market price. The Price of these shares usually remains steady only when there is a change in rate of interest then their market price changes. Proportion of risk. In this type of shares as compared with equity shareholders, the proportion of risk is less due to priority of repayment of capital. Repayment of capital. At the time of liquidation of company, after repayments of all the liabilities, preference shareholders have preferred over equity shareholders to get repayment of capital. Give the meaning of debenture and explain its characteristics. Debenture. When company requires more capital than company issues debentures to raise borrowed capital. Debentures is a liability of the company. Buyers of debentures, that is, debenture holder and creditors of the company. Debenture holders are paid interest at pre-decided rate at specified time and at the end of pre-decided time limit, money is returned or transferred into shares as per condition. This is an important source for satisfying companies' requirement for long-term and medium-term finance. When debentures are issued, trustees are appointed for protection of interest of debenture holders who protect the interest of debenture holders as per trust deed. Characteristics. Creditors of a company. As debenture is a debit of company, debenture holders are creditors of the company. Fixed rate interest. Debenture holders are paid interest at pre-decided rate and time. Charge burden on assets. For protection of money of debenture holders, company creates a charge as security on its assets in favor of debenture holders, means company can use these assets. Necessity. It is useful tool to satisfy the needs for long-term and medium-term finance. Registration to stock exchange. If debentures is listed at stock market then it can be sold or purchased. Repayment. At the end of time limit, the entire amount of debentures are repaid either once at a time or as per agreement of installments. First preference for payment. As the debentures are debt of the company, so at the time of liquidation, along with third party debts, the money or debentures are paid. Types of debentures. Secured debentures. Such debentures, when issued, will charge on assets of a company a security against the money of debentures are called secured debentures or mortgaged debentures. These mortgaged assets can be used by the company. It means a floating charge is granted on the assets. Convertible debentures. The debentures which has a specific time as per the condition can be converted completely or partly into the shares are called convertible debentures. If company had made provisions in memorandum of association, then again such debentures after a specific time and a specific price shares are given in pre-decided ratio. There is a mistake with share. Okay. Non-convertible debentures. These debentures are not converted into shares and debenture holders are refunded money after specific times and conditions. What is blocking back of profit? Explain its advantages and limitations. Retained profit or blocking back of profit. During sound financial position, company earns more profit. Instead of distributing all profits in the form of dividend, company keeps some part of profit in the form of reserves in business for future payment of business liabilities. These retained earnings are reinvested in the business. It is called plowing back of profits. Advantages. Useful in time of recession. Negative changes in the market as well as to face difficulties arising in the time of recession. The retained profit is very useful. Useful in implementation of future plans. For implementation of future plans like development of business unit, expansion of an Modernization, there is a need to raise capital. Company does not have to depend on external sources. Useful to purchase new assets. At the end of estimated life of assets, retained profit can be used to purchase new assets. Fixed dividend policy. And sometimes company adopts a stable dividend policy when retained earning become useful. Burden-free assets. As it is a source of ownership capital, retained profit, there is no need to create burden on the assets. Borrowed capital can be repaid. Retained profits are useful to repay borrowed capital. Decreasing cost of capital. Due to having retained profit, the business unit has not depend on the raised capital by external sources or no expenditure is incurred in getting capital. Thus, there is a decrease in cost of capital. Owner's fund. Logging back of profit is an owner's fund. There is no need to pay interest. Limitations. Encouragement of to monopoly. Excessive logging back of profit encourages monopoly. Promotes speculations. Many times managers of business by paying less dividend carry excess profits to reserve fund. As a result, market price of shares decrease. At this time, directors buy the shares and in future declare higher dividends, and when market price of shares increase, then by selling such shares at higher prices they derive personal profits. Difficult for financial weak for a new companies. Logging back of profit is not possible for financially weak and also for new companies. No benefit to small investors. Small investors invest in business unit for expectation of higher dividend. If directors prefer log back profit more necessary, then small investors do not get sufficient dividend. What is public deposits? Explain advantages and limitations of deposit. Public deposit. Company accepts deposit from general public to satisfy the need for short-term working capital. They are called public deposits. These are borrowed capital as well as debt for the company and investors who invest money in deposits or creditors of the company. The time limit can be from 6 months to 36 months. Company pay interest at a specific rate to deposit holders, which may quarterly, half yearly, or yearly or on maturity of principal amounts. According to the provisions of Companies Act 2013, excluding banking and non-banking finance companies cannot accept public deposits from public. Advantages: easy to receive finance. Well-established and profit-making companies can get finance easily. Less expensive in receiving finance. As compared with other sources of finance, finance through public deposits is less expensive and time limit required is less and also sought. Assets do not have charge. Companies need to mortgage the assets against getting finance through public deposit. Therefore, in future, these assets can be mortgaged to receive additional borrowed capital. Interest is an expense. The interest paid on the public deposit is an expense to the company. Therefore, it is deducted from profit in calculating income tax. The company has to pay less income tax. Used as working capital. To satisfy the short-term finance requirements, the company gets financed through public deposits and thus can satisfy the need of working capital. Limitations. Uncertainty. There is uncertainty in getting finance through public deposit because the mood of the investors cannot be predicted. Insecurity to investors. Public deposits are considered unsecured debt. Therefore, there is an element of risk for the investors. Fair weather friends. Public deposits are considered as fair weather friends because when the financial condition of the company deteriorated or damaging, numerous amount company spread in market, and depositors make a rush to withdraw deposit before the maturity date. This creates financial problems for companies. Therefore, public deposits are called fair weather friends. Difficult for new and weak financial institutions. In the beginning of depositors have no trust in new and financially weak companies. Therefore, investors do not take risk to invest funds in such companies. Explain the functions of financial institutions. Functions of financial institutions. Provide finance for buying shares at the time of incorporation of the company and at the time of modernization and the expansion of financial institutions by the issued share are provided help. Moreover, they also help by offering these services as underwriter, provide finance by giving loan. Financial institutions give loan to the business unit against mortgage. In certain special situations, if there is a need, then over and above assets of company, then they take mortgage of personal properties also. Help through direct payment of technological services. Many times the company have to spend heavily or for technological services. Financial institutions provide technological services on behalf of the company. They make payment directly to such technological companies. Providing guarantee. By becoming guarantor, they offer insurance to other financial institutions. This way they offer indirect help to the companies to get finance. Other services. Financial companies offer help in establishment of companies market research and also providing information for foreigner markets.